Welcome to the Deep Dive, your express lane to understanding the most crucial insights from today's top financial news. Today we're diving into Stewart Information Services, ticker STC, and their second quarter 2025 earnings call.
Yeah, and this isn't just, another real estate services company update.
No, it's really a fascinating case study in how a firm can not just survive, but actually thrive amidst some seriously challenging housing market headwinds right now. Our goal for this deep dive is to peel back the layers, really understand management strategy, and most importantly, explore why all of this should matter to you as an investor.
It truly is a remarkable story, especially when you consider, the broader economic landscape. Stewart delivered a performance that, frankly, turned heads across the market, significantly outpacing expectations.
Definitely turned heads. And when we talk about outperformance, we're talking about some pretty impressive numbers right off the bat.
Yeah.
Let's maybe start with the results snapshot. On a GAAP basis, that's generally accepted accounting principles. Sort of our standard accounting playbook, diluted earnings per share, came in at $1.13. Now, that's a substantial jump from just 62 cents in the same quarter last year.
Exactly. A really big leap. And for those looking at the cleaner, adjusted figures, EPS hit $1.34.
Right.
What's crucial here is that this comfortably beat consensus estimates of around $1.30 by about 3%. It signals a company not just meeting, but exceeding analyst confidence.
Yeah, beating the street. And it wasn't just the bottom line turning heads, was it? Revenue figures were equally robust.
That's right. They reported $722.2 million on a GAAP basis, marking an impressive, 19.9% year-over-year increase?
Almost 20%. Again, this blew past analyst projections, exceeding estimates of like $669 to $672 million by a solid 7 to 8%. So yeah, we're seeing strong growth both on the top and bottom lines.
And, if we're looking at the health of the business, the significant improvement in net cash from operations is a real standout. It rose to $53.4 million from just $21.1 million in the prior year. This isn't just a number. It fundamentally highlights robust operational cash generation. They're turning revenue into actual cash in the bank much more efficiently.
That's a strong indicator, definitely. Yeah. And they weren't just growing revenue. Sounds like they were also managing risk effectively.
Yeah, their title loss ratio improved to 3.6% compared to 4.2% last year.
Okay.
For those who track this, that means they're paying out less in claims relative to the premiums. They collect a clear sign of stronger underwriting discipline, even with market pressures.
And they expect that to hold.
Well, they're expecting to average around 4% for the full year 2025, which suggests this isn't just a one-off improvement.
Good sign.
Indeed. This kind of robust performance, especially, against the backdrop of a challenging housing market, was naturally met with a very positive market reaction. The stock saw a notable surge immediately following the announcement, reflecting investor confidence.
It certainly got people's attention. Now that we've seen those impressive top-line numbers, let's really peel back the layers and understand where this growth is originating from within Stewart's engine room, specifically their segment performance.
Right.
The title segment was a primary driver here, with its operating revenues increasing by 19% year over year. What's fascinating is that this wasn't just revenue growth. It led to an adjusted pre-tax income surge of 35%.
Yeah, 35%.
And an improved adjusted pre-tax margin of approximately 8.5%. That's some nice leverage at play.
And that leverage is critical. But it's not just about title. What's equally important to note is the substantial contribution from their real estate solutions segment.
Okay, tell me about that one.
This segment saw revenues up 22% and adjusted pre-tax income increasing by 15%. They achieved an adjusted pre-tax margin of nearly 10.9% in this segment.
Wow, even higher margin there.
Yeah, though management expects these margins to normalize a bit, maybe in the low teens for the remainder of the year. But still, this strong showing from a diversified segment really highlights their strategic pivot and resilience.
That diversification certainly seems to be their strength right now. Is there any risk, though, that this broad approach could dilute their focus in their core title business? Or is it truly additive, you think?
That's a fair question. What's interesting is how they're managing that. They're making targeted investments in both areas, suggesting they see them as complementary rather than competing.
Right.
The real estate solutions segment, with its technology focus, actually strengthens their overall offering, potentially creating, cross-selling opportunities and sticky client relationships.
Yep.
It's less about dilution and more about building a broader ecosystem around the real estate transaction.
That makes sense. And when you look at the specific growth drivers, management was keen to emphasize growth across all business lines, even amidst what they call persistent housing market headwinds. One figure that truly jumped out at me was the 46% year-over-year growth in domestic commercial business volume. What's the story behind that surge, especially in this otherwise subdued market?
That 46% growth in domestic commercial isn't just a big number. It signals a deliberate, successful strategy to pivot towards less rate-sensitive segments.
Right, insulating them a bit.
Exactly, effectively insulating Stewart from the residential market's volatility. It tells us they're not just surviving, they're actively repositioning for long-term resilience. This wasn't accidental. They saw an opportunity and executed.
And it was coupled with the average fee per commercial file increasing by a significant 25% to $16,900. So it's not just volume, it's higher value deals too.
Precisely. More value per transaction.
What's more, management specifically highlighted a focus on small commercial within direct operations, which delivered a robust 36% growth rate. How does small commercial differ from the larger deals, and why is that particular focus maybe a key to their success right now?
That's a great question. Small commercial typically refers to transactions like smaller office buildings, retail spaces, maybe multifamily properties that might not grab headlines like a skyscraper deal.
Right.
But they represent a much broader, more consistent base of activity. They can be less susceptible to the mega economic cycles that affect very large commercial developments.
So steadier work.
Yeah, exactly. By focusing on this segment, Stewart is essentially broadening its net, capturing more frequent, if individually smaller, transactions. And that's incredibly smart in a volatile market.
It sounds like a smart move to capture a consistent business. And the agency service business also delivered strong results, right? Gross agency revenues increased 25%.
Yeah, another strong point.
This indicates continued market share gains, even with a relatively flat residential market overall. They're particularly laser-focused on 15 key states for significant scale and growth. What does that targeted approach imply?
It implies strategic resource allocation. Instead of spreading themselves thin, they're concentrating their efforts and investments where they see the highest potential for impact and market leadership.
Makes sense.
This isn't just about growing in general. It's about growing efficiently and dominantly in specific high-value markets. This focus helps them build deeper relationships and operational efficiencies there.
Beyond just the organic growth, we also saw a strategic acquisition. In early July, Propstream, that's their real estate data and analytics platform within the real estate solutions segment, acquired Batch Leads and Batch Dialer.
Right.
This acquisition seems like more than just adding features, isn't it?
Absolutely not just features. This is a strategic move to transform Stewart into more of a tech-driven real estate solutions provider.
Okay.
By combining Propstream's powerful data engine with Batch Leads' AI-driven tools and contact dialer, they're moving beyond traditional title insurance into the broader transaction ecosystem. They're enhancing data intelligence, lead targeting, client engagement.
So really broadening their toolkit.
Exactly. It's about building a digital moat around their services and expanding their revenue streams into the analytics and lead generation space. This feels like a long-term play for increased relevance and profitability.
Yeah, that makes sense. Even their international business saw modest growth, with non-commercial direct and commercial direct revenue up about 6%. And the company's also making targeted investments in talent to expand its network and capabilities in more geographies and asset classes, particularly in that booming domestic commercial business. It's clear they're not standing still.
No, definitely not. And it's important to connect all this strong internal performance to the bigger picture of navigating the current housing market, which management explicitly stated remains stubbornly challenged.
Stubbornly challenged, yeah. We're seeing low existing home sales, down approximately 1% compared to Q2 2024.
Right.
And persistently high mortgage rates in the high sixes, pushing sales to around, 15-year lows?
Yeah, really low levels. And price appreciation has cooled significantly. Q2 saw only around 1.5% appreciation compared to 3% in Q1 2024 and over 4.5% back in Q4 2024.
Quite a slowdown.
Definitely. While management expects some improvement in the second half of 2025, the magnitude and timing remain, well, unclear.
So while the macro picture is tough, Stewart's diversified revenue streams, particularly from commercial and real estate solutions, seem to be effectively mitigating these residential pressures. It sounds like they're making lemonade out of some very sour market conditions.
Precisely. Their diversification is proving to be a critical ballast. And this brings us to a nuanced point regarding the residential refinancing market, the refi market,
Right.
which currently represents a really small percentage of Stewart's total revenue, only around 3%. Management views refi as basically just upside and hasn't heavily invested in this segment, prioritizing commercial and purchase businesses instead.
Right. And for context for everyone listening, a typical retail or purchase deal has a premium of around $3,000 for Stewart, whereas a refinance deal is much lower, maybe $1,000 to $1,400.
Big difference.
Yeah, that difference in premium clearly influences their strategic focus. It's a pragmatic choice to chase the higher value transactions right now.
What's also kind of interesting are management's comments on recent pilot programs that might refine the model for title insurance, especially those that retain the policy and the curative aspects. They believe if such pilots prove successful and offer a viable solution that includes a title policy, Stewart could participate because they have the existing technology and workflows.
So they're keeping an eye on potential industry shifts.
Yeah, it's a very forward-looking perspective, acknowledging potential industry evolution while positioning themselves to maybe capitalize on it without impacting their current stable profile. It speaks to their agility, I think.
And finally, on the financial deep dive, investment income, that's on an increase too.
It did. The increase in investment income was primarily attributed to the higher yield environments we're seeing, plus increased balances. And that commercial growth is also expected to contribute positively to this line item over time, which adds another layer of stability.
Okay, so if we connect all these details to the broader investor context, what does this mean? Stewart's Q2 performance is highly relevant for investors seeking resilience and strategic positioning within the real estate services sector, wouldn't you say?
Absolutely. The company's ability to significantly grow revenue and earnings despite a tough housing market really underscores the success of its strategic diversification and operational execution. This isn't just about good numbers for a quarter, it's about a fundamentally sound strategy playing out.
The market certainly took notice. The stock rose approximately 9.06% intraday on the day of the earnings call, closing around $59.51.
Big jump.
Then it gained another 10.2% the following day, closing at $65.58. And in the month following the announcement, the stock continued to drift up by about another 3.6%, most recently closing around $70.62. That kind of sustained positive reaction speaks volumes.
It does. The overall sentiment from analysts and media has been quite bullish. Some fair value models are highlighting a low price earnings to growth, or PEG, ratio of approximately 0.31.
Which is quite low.
Yeah, which is often seen as a bullish signal that a stock could be undervalued relative to its expected earnings growth. This suggests that even after the run-up, there might still be, gas in the tank.
And their balance sheet is solid.
Rock solid. Stewart's healthy net cash from operations, a strong balance sheet, with approximately $390 million in excess cash and investments, and a fully available $200 million line of credit, provide a solid foundation for future growth and potential M&A activities. It gives them options, lots of flexibility.
So what does this all mean for the long game then?
Well, it looks like the company is strategically evolving from being, primarily a title-centric business into a more durable, services-diversified firm. They're strengthening both their traditional title operations and their technology-enabled real estate solutions segment.
Right.
And while management didn't provide specific forward guidance, they expressed confidence in their ability to continue growing revenue and earnings even in this challenging market. They're aiming to capitalize on improvements when the market eventually normalizes, projecting an ability to sustain growth that outperforms the overall market.
So they're not just waiting for the tide to turn.
No, they're actively steering the ship, making moves to control their own destiny, regardless of the broader market waves.
All right, so for the adventurous allocators in the room, given all these robust indicators and strategic pivots, what does this actually mean for an investor trying to navigate this market? Here's maybe a structural takeaway for consideration, perhaps even outrageous but plausible trade idea.
Okay, let's hear it.
Considering Stewart's impressive 46% year-over-year growth in domestic commercial revenue and their strategic insulation from residential headwinds, we could be looking at a compelling long opportunity here in STC.
That's a bold claim, but the numbers certainly support their strategic execution so far. What's your kicker, though?
My thesis: go long STC, but here's the kicker. Pair it with a short position in a pure-play residential mortgage originator, one with high refinancing exposure.
Ah, pairs trade. Interesting.
Yeah, the idea is that Stewart's diversified model is proving its mettle in this high-rate, low-transaction residential environment. Meanwhile, those pure-play originators will likely continue to be hammered by a lack of refinance activity and suppressed purchase volumes.
Right.
So this isn't just a bet on Stewart's operational excellence. It's a structural play on the current market dynamics, favoring diversified real estate services over rate-sensitive residential lending.
Makes sense, if rates stay high.
Exactly. If rates remain elevated or even tick up, Stewart's commercial and solutions segments act as a ballast, maybe even continue to grow, while the pure play originator continues its downward spiral, potentially amplifying your long STC gains. It's a thesis built on that divergence.
It's certainly a compelling way to express conviction in Stewart's strategic direction, while hedging against, or even betting against, parts of the broader residential market. Definitely food for thought.
So in summary, Stewart Information Services delivered a really impressive Q2 2025. Demonstrated strong top and bottom line growth, driven by smart strategic investments in its commercial and real estate solutions segments.
Yeah, effectively navigating and arguably even thriving in a challenging housing market.
Exactly. The positive market reaction and their diversified business model underscore confidence in their future prospects, suggesting they're building a more durable business for whatever the market throws at them next.
And just a reminder for everyone listening, the information discussed here is purely for informational purposes only. It is definitely not financial advice.
Absolutely. We strongly encourage all listeners to conduct your own due diligence and consult with a qualified financial advisor before making any investment decisions based on anything you hear.
Please do.
But we do value your insight, so feel free to share your thoughts on Stewart's Q2 performance and what strategic moves stood out most to you. What do you think their next big play might be? We'd love to hear it.